Hey guys, and welcome back to another video. And today, as you can see on your screen, we're going to be talking about high yield bond ETFs. Now don't click off just yet because we're going to be talking about a fund that returns around 7% per year, which is a lot higher than some of the T-bills that we've been talking about. Now, obviously, there's going to be advantages and disadvantages to everything, and so we're going to be covering some of those today. But the reason that we're covering this is actually because of a comment down in the comment section down below by 2001 Cobra Saline, I think. So if you want to have your comment and your video idea potentially featured in a video, make sure to leave any of your questions or suggestions in the comment section down below, and you could end up in a video like this one. So what exactly is a high yield bond? You can see here that they're actually also called junk bonds, which sounds kind of gross, but to go with that, there's a higher interest rate. As we know in the market, with higher risk always comes higher reward. And I'm going to show you a graphic to explain that a little bit more in just a second. You can also see that they are more likely to default. And basically, when a bond defaults, that means that the company doesn't have sufficient funds to pay its interest payments, and so they miss a payment. Here's that chart that I was just talking about, and I think it gives us a little bit more of a visual explanation of what we're talking about. So you can see that a company that's more reliable, an investment grade company, is going to return lower percentages. And don't pay attention to the exact numbers. This chart is actually from 2021, so not necessarily super relevant, but it still conveys our idea. So you can see something like the US government that sits in this range is generally going to return a lower percentage because the chances that they pay their interest, that they don't default, are much higher versus a company that's a lot riskier. A non-investment grade bond is going to pay a lot higher percentage. In this case, in 2021, they were averaging over 9%, but the chances of this company defaulting, not paying you your interest because they're not able to, is a lot higher. So once again, higher risk, higher reward. That's just kind of how the market works. Another advantage to these high yield bonds, in this case, I'm specifically using HYG, which was the company asked about by the comment, is that they don't fall or rise as much as the market. They're much less volatile. For example, here in the crash of 2020, it only dropped by around 21% versus the Dow Jones dropped more than 30%. And so for people that are looking for a little bit less volatility, a little less stress, this could be a better option for you. One concern to have with these high yield bonds, however, is the fact that they're not very recession proof, meaning that when people are concerned about the economy and its future, these tend to drop. And we can see that here since around the start of 2022, when people have been talking about this recession caused by so much inflation and rate hikes. This fund has begun to drop a little bit. And the reason why is because of those defaults that we talked about earlier. If the economy falls into a recession, then these companies aren't going to be able to make their payments. They're going to be struggling. The bonds are going to default, and the returns on the bonds are going to drop a ton. So now let's go ahead and have a look at two examples of high yield bond ETFs that you could potentially take a look at. And the first one's going to be maybe our favorite. It is SPHY, and we're going to be going ahead and looking at two very important things. First off, the expense ratio is only 0.05%, extremely low compared to a lot of other ETFs. And then when we go ahead and have a look at the distribution yield, it sits at about 7.03%. So every year, this fund at this point would produce around a 7% return. Now, one of the biggest risks that we've already talked about with these high yield bond funds is those defaults, the companies that can't pay their interest payment due to some sort of struggle with their business. But one of the reasons why ETFs are so great for this is diversification. This fund holds 1,900 different companies, meaning even if a big chunk of them, a handful of them default, that's not going to be a super big deal. This fund does also diversify pretty well throughout the sectors. You can see finance does dominate it just a little bit, but the diversification goes pretty well. It even expands beyond the country. And in this bottom left corner, you can see some of their top holdings. We're not talking about companies that you've never heard of that are super sketchy. We're talking about American Airlines, Dish, DirecTV, names that I'm sure you've all heard of. For this particular fund, I believe the default rate is around 3 to 4%, meaning 3 to 4% of the bonds held in this ETF aren't actually paid out, and it is still returning a 7% yearly rate. Now, the next ETF that we're going to be talking about is actually called the Fallen Angel High Yield Bond ETF. But first, we need to understand what is a fallen angel. Basically, what this is a bond that was initially investment grade, meaning it was to the left side of that graph that we looked at with lower rates, but has since been reduced to junk bonds or high yield bonds, meaning that there was some sort of problem with the financials of the company, and so the investment grade bond becomes a junk bond. It becomes a little bit less reliable, but with a little bit higher rate. Specifically, the ETF that we're going to be going ahead and talking about is ticker symbol ANGL, the Van Eck High Yield Bond ETF. And here's those two very important things once again. This one pays out a monthly dividend of 13 cents, which I went ahead and did the math, and it totals out to around a 5.64% return per year. You take out the expense ratio of 0.35%, and you're going to be returning right around 5.3%. Another huge advantage of these high yield bond ETFs that I've failed to mention so far is the fact that this dividend of 13 cents monthly is something that's very common, at least the monthly part of it. Almost all of these high yield bond ETFs return monthly dividends, so you're going to be getting paid a little more often than if you were to just invest into normal bonds. Now, at this point, you might be thinking, why would I want to invest in something that's companies that are going downhill? But once again, just like the last ETF that we talked about, these are not companies that you've never heard of. I'm sure that you've heard of Rolls-Royce, Delta Airlines, some of these other Vodafone. These are things that you've heard of before. They just took a little bit of a downgrade when it comes to their credibility. But as you can see, some of them are returning pretty high percentages. I hope you've gone on to enjoy today's video. Just as a little bit of a recap, we talked about high yield bond ETFs. They're a little bit riskier than normal bonds, but with higher risk comes higher yields. We also talked about the fact that they're less volatile, meaning that they'll go down less than the market, but they'll also come up a little bit less than the market. They're hurt by recessions, and once again, the reason why is because of the default rate. The default rate is going to go up when these companies are struggling financially. And last of all, we talked about the fact that we receive monthly payments with these, which could be an advantage for you. Thank you so much for watching. I hope that you've been able to learn something new, or at least to solidify what you already knew. Please leave in the comment section down below any comments, suggestions, questions, or video ideas so that you can potentially be featured in the next video. But other than that, we'll see you in the next one.